Good afternoon to you. At the moment, I'm reading some quotes from inside the Oval Office. The president says he's very happy with things. We're advised that President Trump still has to sign off on this recommendation on behalf of the DOJ. Nonetheless, this is moving quickly at this time. This is exponentially better than our friend that Biden would have been because it includes the doubt that it does not.
And it's 1:28. So if you want to, you can do that, and we'll just go on mute. And then at 1:30, I'll go on and just say we're going to wait for everyone to get here.
So you want me on mute?
Yeah. Well, you don't have to be on mute. You don't have to say anything. But
all right, I'm going to open it up to attendees to arrive then.
Right.
Okay, so they're going to start coming in.
Hi, everyone. Welcome to Tedstrom Talks. We're going to give this a couple minutes and let more people log on. So just bear with us for a few minutes and we'll be right back. Okay, we're about to begin. Welcome to Tedstrom Talks.
Well, good afternoon, everyone, and welcome to our new webinar series, Tedstrom Talks. My name is Peter Tedstrom, founder and chief advisor at Tedstrom Wealth Advisors, and this is the third in our series of webinars that we're producing to give our clients, prospects, business associates, friends, and family critical and important information during the COVID crisis. We're also presenting different topics that might just be of interest to you while you're isolated, to give you something else to do and to learn about. Today, we're going to be talking about the road to recovery. Burt White has been with LPL since 2007. And LPL is the largest independent broker-dealer in the nation. Currently, Burt is Managing Director of Investments and Investment Solutions and Chief Investment Officer at LPL Financial. He oversees a high-performing organization responsible for developing the innovative products and services that enable LPL to support advisors in all facets of their business. Burt sets the vision for superior research capabilities and ways to optimize LPL's product and platform delivery. He also leads data analytics and business intelligence. Burt and I have been buddies since probably about 2007. We've both gotten a lot older, hopefully a lot smarter. And there's a lot going on out there these days, Burt. Can you help us make some heads or tails out of it?
I'm going to try to do that. Thanks for having me. It's been a little bit since we've chatted, but man, the world has changed, and I can't wait to see you in person again soon. That'll be fun as heck. Yeah, let's try to do that. In fact, I might actually try to share a screen here and just be able to showcase a few slides here, and that might allow people to follow along a little easier, if that's okay. So let's pull this up, make sure everyone can see it. Hopefully everyone can see that. So here's what we're going to do today. We're going to try to talk about and make a little sense of this market. What the heck is going on out there? it's funny, not funny. One of the things we oftentimes talk about is that usually the way economic cycles end, usually how you go from expansion into a recession is that we have the Fed raise rates and it slowly slows down the car. We oftentimes talk about applying the brakes. And so the Fed applies the brakes because the economy gets a little overheated. Eventually the brakes are just put on too much. Eventually the car stalls. We have a recession. We got to restart the car and go again. That did not happen this time. This time the car hit a tree. And that doesn't happen very often. But from time to time, we do have catalysts that cause recessions. That is rare. Generally, it is the fact that an economy is so strong that we have to slow it down a bit. And as we're slowing it down a bit, we just over slow it down. That is the number one way that we have recessions. In fact, almost 90% of recessions occur that way. The less likely way we get a recession is the way we had it this time, which is where we hit a tree. And that's what we're going to talk a little bit about today. Before I do that, I have, there's this is in my bedroom. This is what I wake up to every day. And I just want to say, it's one of my favorite lines. It says, even after all this time, the sun never says to the earth, you owe me. Look at what happens with love like that. It lights the sky. I will tell you, for our first responders and for our moms out there, this is certainly for you. There's a lot of love out there, and we're going to need a lot of love to get through this. And I'll tell you, one of the things that concerns me a bit is how polarized our country is becoming. And I think the closer that we can get it, realization that we can do this together, and do this with love and compassion and carefulness and everything else, we'll get through this. We will get through this. So let's talk a little bit about the markets, if we could. One of the things I oftentimes talk about is like what makes things scary. And I was thinking about this the other day. What makes things scary is, I think, three things. Number one is things are unexpected, they're out of our control, and they happen really quick. Think about this when you walk around the corner and, I don't know, someone jumps out from behind the corner and goes, boo. What makes that scary, and the reason you're startled, is because it's unexpected, it was out of your control, and it happened really fast. If they did it really slowly and was like, boo, or you knew they were there, it wouldn't be scary. And that's really what happened here. Think about what happened. It happened so fast, it happened so sudden, and it was clearly really unexpected. That based on all of that, this has really created an environment where it has created a lot of fear out there. One of the things that I would steer to really quickly is that oftentimes, when people think about previous outbreaks, this isn't the first one. We've had other ones. We had SARS and bird flu and Ebola and Zika and a bunch of others. The reality is, when this first happened, the market looked at this and thought, this doesn't seem like we've seen this picture before. We saw what swine flu did, and we saw what Ebola did, and the market sort of ran right through that. And so this is where I think it caught the market by surprise a bit. When this first got reported really in January, the market sort of plowed forward to all-time highs through January and February, and it was because it was looking at this. It thought that this coronavirus was going to be like SARS or like bird flu, and applied these paths to it, which clearly is not what we got. In fact, what we got is this. This is actually my favorite headline. This was out of a newspaper I saw probably 5 or 6 years ago, and I think it describes exactly what happened. The headline here says, "Bear falls through skylight into party, then eats all the cupcakes." That is exactly what happened. This economy was having a party. We had lots of cupcakes. We were in the longest expansion we've ever had coming out of the Great Recession. We had a really strong economy. Earnings were really good. Employment was really good. Business was really good. And then out of the blue drops a bear. A bear market drops right out of the skylight, eats all of our cupcakes, and sending us running to the closets. And that's really sort of the story for this. One of the things that just to demonstrate how quickly this happened, what I have here on this slide is a listing of all of the bear markets that we've had, the major bear markets. Now, remember what a bear market is. A bear market is when the stock market drops 20% or more. So 20% or more. And what we're measuring here is the number of days it took the market to drop 20%. If you go to the bottom of the screen, you can see 2001. This was coming out of the Y2K, the tech wreck, the 1999 internet bubble. It took 417 days for the market to actually decline 20%. 400 days. Go to the top. This was the fastest move to a bear market ever. 19 days to drop 20%, and then about 25 days to drop 35%. The next closest was 1898, right around when Peter's birthday was, and that was 36 months or 36 days. So this was like by a factor of 2, the quickest move to a bear market ever. Now, what did it do? What it did is a couple of things, right? The main thing it did, and I want to just, as I focus on this slide really quickly, there's 2 things I want to gear your eyes to. The first thing I want to gear your eyes to is the blue arrow there. And it's under the length of expansion. These are all the expansions. Now, what is an expansion? We have a recession. That's what we're going in right now. And then the market recovers, and we call that an expansion. The market begins to then go for a while, and then we have another recession, and then the market has an expansion, and then a recession, and so forth. And so this is what we're measuring is how long these expansions were in between recessions. And you can see that going back to World War II, this is the longest expansion we have ever seen, 128 months. It eclipsed the one from 1991 to 2001, which was 120 months. But this was by far the longest expansion ever. But if I gear your eyes to the orange, what you'll see is how much nominal GDP advanced. Now, what is nominal GDP? That is fancy talk for people like me to measure our economy. How far did our economy grow? Now, we oftentimes mistake the market for the economy. The market is very different than the economy. In fact, you're seeing that now. Our economy is not doing very well, and the stock market actually has recovered quite a bit here over the last month. We'll talk about why that is. But the market and the economy are 2 very different things. They're similar, but we shouldn't confuse them because they're looking at different stuff. Now, what we're measuring here is nominal GDP is the economy, and the economy grew 50% or so through the 128-month longest expansion ever. The stock market grew almost 400% over that period of time, but the economy only grew 50. And if you look below it, that's kind of average. That's sort of an average growth. So we had the very longest expansion. You would expect that the longest expansion would generate the biggest amount of growth, but it didn't. So why is that important? What it means is that when we were entering into this particular recession, we entered into this crisis, we weren't overextended. It's not like this economy had gotten so big, that this economy advanced so far that it was over its skis. One of the things I like to say is that the healthier you are when you get coronavirus, the more likely you're going to be able, and the quicker you're going to be able to get through it. And we've heard that from our doctors and so forth. The same is true for our economy. The stronger you are heading into these crises, the better you can withstand it and the quicker you can recover. It doesn't mean you're not going to get sick. It just means you can recover quicker. And that's why I think the market is beginning to be forward-looking. I'm foreshadowing. We'll get to that in a second. All right, let's move to the next slide here. For whatever reason, that's not working very well. Okay, let's try this one. So when we think about crises, one of the things the market has been looking for to find its bottom is a couple of things. And we're going to go through a few of those things in a second. But the most important thing I want to say is this, that markets bottoming is not a day. Now, we'll look back on this a year from now, 2 years from now, 5 years from now, and we'll say, the market bottomed on that day. But markets don't bottom on days. It's a process for a market to bottom. Sometimes it will hit a low level, it will bounce a bit, it might go down again, it might go down a couple of times. But the reality is it's a process for the market to find its bottom. And so I'm going to go through some of the reasons why I think the market has begun finding its bottom. Now, I believe, my personal opinion is, that we will see lower levels in the market than we set today. I think the market is pricing in a fair amount of optimism, and I wouldn't be surprised if the market dropped 5 or 10% or so. It could drop a little more, But my current thought is it might drop about 5 or 10% at some point, we don't know, over the course of the next few months. That said, I also believe we're going to close the year higher than we are today, which tells you that I believe that the market is actually forward-looking and beginning to look through positive times. Now, with all that said, why did the market find its bottom? Now, remember what happened. We had the coronavirus really hit. The market peaked in February. In fact, our closing low, our all-time high was February 19th for the S&P, right around 3,400. And then it dropped 34% in 25 days. And really found its bottom sometime in, the 23rd of March. Now, remember, that's actually when we started seeing cases really begin to move higher. So the market was moving in an opposite direction than that. So why? Number one, the market began to look at this. When we look at all kinds of crises, and we've kind of gotten a bunch of historical big crises here. Wars are in here. Pandemics are in here. Assassinations are in here. All kinds of stuff are in here. Recessions are all in here. And what you find is that by and large, a year later, the market's usually up. Not always, but you can see about 75% of the time it is up because it's forward-looking. The market's not looking at what's going on today. It's trying to forecast what will be here tomorrow. And by tomorrow, it's usually looking out about a year to 18 months. And the market giving you a relatively bullish sign, it's not saying that things aren't going to be tough today or tomorrow or next week or next month. What it's telling you is that it actually has optimism of what next year might look like. And that this would actually be something that we can rebound quickly. All right. The next thing is this isn't the last pandemic. Remember, we talked about the SARS and the Ebola and some of those more recent pandemics. But that's the wrong comparison. We've actually had two really bad pandemics. It just so happens they're every 50 years. 1918, we had the Spanish flu. Then exactly 50 years later, we had the flu pandemic of 1968, 69. And then 50 years later, we had COVID-19. Literally a 50-year cycle, which is really just pretty interesting there and maybe ironic. But the reality is, notice where the market bottomed in those. In 1918, the market lost 33% and then began to recover. In 1968, the market lost 36%, then began to recover. COVID looked at those and said, wait a minute, we're dropped here 34%. This is the zone, and began to rally. So this is a spot where typically these 50-year flu outbreaks typically see the market finding support. Let's move to the next slide. The other piece is that stocks usually lead the economy. Remember, I told you there's a big difference between the economy and the market. The economy is looking at today. We have had terrible, awful economic numbers come out. Another 3 million Americans filed for unemployment claims this week. That brings 33 million Americans. That's about roughly 20-some% of the workforce. If you look at continuing claims, because some of those folks have found jobs, continuing claims say more like 24 million Americans or so are unemployed right now, which will put the unemployment rate about 18% or so. We'll find those numbers out tomorrow when the payrolls come. But that's terrible numbers, right? Those are awful numbers. Consumer spending in March was down 8%. That is an all-time worst low by a factor of 4. The worst month we ever had was down 2. It was down 8, right? And go on and on and on. Really tough economic periods. And yet stocks typically are forward-looking. What we're looking at here, if you take the first column over there with the numbers, that is the length of a recession, how long the recessions usually last. Typically, recessions last about a little less than a year. On average, it's about 11 months. I'm not so sure if this one might be a little quicker. We're forecasting more like 7 to 8 months for this recession. But here's what's important. Look to the far right side. This is when did the market bottom before or after the recession? In fact, that negative number is the only one where it actually bottomed after the end of the recession. All other periods, it actually bottomed before the end of the recession, and on average 5 months. So what does that tell you? The market is beginning to forecast that this recession will be over about 5 months from now, which is probably maybe a little optimistic, but relatively in line with, a typical recession that might last 10 or 11 months, like the typical one, or this one might be a little quicker just based on how it came and so forth. So what are we looking at? Here? A couple of things. Number one is this is our Road to Recovery playbook. These are the 5 things that I am looking for to really say that I think the market is sort of really firmly in the bottoming process. So let's go through each one of these 5 things really quickly, and then we'll, in a bit, open it up for questions here. So here are my 5 things that I'm looking for to really be evidence that the market is finding its bottom. The first thing, that there is confidence in the timing of a peak of new COVID cases in the US. Now, there might be a second wave. I'm not sure of that. Let's see what plays out. But we're talking about the first wave. And if you look at the data, it looks as if in the United States, aggregately across the United States, it looks like we have peaked and peaked in COVID cases. Doesn't mean that there's still not a lot out there. There is tons of COVID cases. Still lots of new cases that are coming in, and clearly lots of deaths. But the reality is the market's not looking for it to be eradicated. The market is just looking for it to not get any worse. And the reality is that at least what the data is showing, that is about where we are now. Signal number 2. Signal number 2 is that you can predict the severity and the probability of the recession. Well, I can predict the probability. We are in a recession. So there's a 100% chance we're in one. The question is, how big of a recession are we in? Remember, there are 2 types of, the average recession drops about 35, 36%. Again, right around that zone of what we saw the 34% move lower was. I think this is probably a little worse than your average recession. Our worst recession, the Great Recession, stocks dropped a little north of 50%. What would that tell you? It means that is it possible that we might get to that? I guess it's possible. I think that's highly unlikely. I think that we probably have seen the lows of this cycle. Doesn't mean that that's true. Things could break in a different way, but at least what we know today, I believe we've seen the lows of this one. So that's number 2. Number 3, that the market has the market priced in a recession. I believe the market has priced in that recession. Remember, it dropped 34%. Check that one off. Number 4, this is a sort of in the weeds one. It is that sentiment and technical analysis, meaning folks that kind of look at charts and so forth, indicate that a limited number of sellers remaining, meaning anyone that wanted to sell stocks did. Anyone that wanted to have fear-based selling already did that. We saw that in March and April. That already happened. So the reality is, I mean that more people can't sell. It just means that, that the panic selling we already had. One of the evidence we look at is the percentage of stocks that hit their 52-week low. We got to a point where 99.9% of stocks hit their 52-week low. That is washed out. That's a good sign. And lastly, and maybe most importantly, is that policy responses have been sufficient to restore confidence. This is monetary policy, our Fed, as well as fiscal policy stepping in with stimulus packages. You add those 2 things up between what the Fed and what the government has done, it is $7 trillion. $7 trillion. It's a third of our economy. That is 4 times bigger than any of the stuff that was happening in the Great Recession, and by far the biggest amount of stimulus ever. So just to put this into perspective, because sometimes big numbers, we just sort of zone out of big numbers. Let's just think about this for a second. 1,000 seconds ago was 17 minutes. That's about how long I've been talking. I know it feels like I've been talking for an hour, but it's been about 17 minutes. 1 million seconds ago, 1 million seconds ago was 12 days. So 1 million seconds, if you go back 1 million seconds, that was 12 days ago. 1 billion seconds, if you go back 1 billion seconds, that's 1988. So the question is, how big is 1 trillion seconds? Now, the number one response I usually get from 1 trillion seconds is 1500s, 1600s or so, not even close. 1 trillion seconds ago was 30,000 BC. Think about that now. Imagine doing one Mississippi 2 Mississippi, 3 Mississippi, all the way back to 30,000 BC. That is $1 trillion. We have had 7 trillion. That is 210,000 BC worth of seconds. That's the amount of dollars that has flowed into stimulus. That is a lot, my friends. And that is one of the reasons why the Fed and our government has backstopped this economy. Now that comes with costs. We're going to have to pay that back at some point. But the reality is that has been an enormous backstop to this economy and helped the market find the bottom. In fact, I told you that on 3/23, the market found its low. Well, on 3/24 is when the Fed announced its big package. No coincidence there. So how long until we recover? Well, we don't really know this for sure, but here's a listing of all the sort of bear markets that we've had out there. I want to focus you on the blue arrow there. You can see in the blue arrow, what it shows is the average of all bear markets dropped about 30%. The average of a bear market in a recession, this is where we are. We are in a recession and we had a bear market. It means it dropped about 37%. Remember, we dropped 34. So that's in line. That's right there in line with that. So think about all these coincidences. The average pandemic, remember the 50-year pandemics, those dropped in the mid-30s. Same with where we are. The average bear market recession drops in mid-30s. That's about where we were. And so all those things sort of got kind of demonstrated that is probably the low of this market. Now move to the right there under the orange arrow. And that will show how long does it take to recover. Now, what it says is that for the average of bear markets, it takes about 20 months. For a recession, which is what we're in, it's more like 30 months. Now, that's typically, but you can look back over time, you can see some as short as 3 months or 4 months or so forth, right? And so it kind of ranges. The reality is this. I think that we will recover faster in this one. The quicker in, typically the quicker out. The slower in, typically the slower out. It doesn't always work that way, but usually it works that way. And when you hit the tree, you got to quickly get the car back on the road. And I do think we will. I think at the end of the year, we'll see levels at this or maybe even higher than we are today. But I wouldn't be surprised if the market pulls back just a bit at some point. And this is the point. We have seen a big rally. We oftentimes call these bear market rallies that happen off the bottoms. In fact, the market, remember I told you the market declined 34% off the highs down to the lows. It's actually rebounded 29% since then. Now, we still set about 17% from our previous levels. We've still got a long way to go. And I wouldn't be surprised, sitting where we are today, if we wouldn't see slightly lower levels, again, 5 or 10% lower levels at some point going forward. It could be worse than that. But I don't think we're going to break the lows of down 34. I think that is that zone of where the average recession is. That's that zone where these pandemics typically bottom. So by and large, I think that's very strong support. If the market moved back down lower than that, I think that would be a really, really attractive long-term buying opportunity. I think now is an attractive long-term buying opportunity. If you're looking out a year like the market is, if you're looking out 2 years or 3 years or 5 years, I think buying this economy here at 20% discounts from where we were just a couple of months ago is actually not a bad idea. The last thing I would do is just remind everybody, stay with your plan and focus on the long term. One of the things that I believe in, and just a couple things. Number one is that there's economic recessions and then there are confidence recessions. And I think we're in both. We are in a recession for our economy, but we are also in a recession of confidence. And when we are really going to get out of this is when consumers are confident enough to buy, when businesses are confident enough to hire, when investors are confident enough to save, and when we as families are comfortable enough to go outside. And when all those confidences happen is when this will be completely over. And we're a ways from that. But the market's beginning to forecast that might be a year from now, or that might be sometime later this year or into 2021. And so we'll see how that plays out. That's the first thing. The second thing is this is going to be as much of a emotional recovery than it is economic recovery. I don't think that this world's going to go back exactly to where it was before. I do not believe that this was a pause in the movie. 5 months later, we'll unpause the movie and we'll be back to where we were. I think this world's forever changed. I don't know if for the better or for the worse. I don't know what it will be. What I will say, though, is that the one thing I am confident of is throughout time, the superpower of humans has been perseverance, it has been community, it has been collaboration, it has been communication. And I think that we're going to learn from this that we missed each other. I know I miss Peter, and so I can't wait to give him a hug at some point. Right now, I got to stay a long way away from him, or at least 6 feet. But at some point, I'm going to bear hug that guy. So the reality is, I think we have that. The last point is we have to be careful about the swings of extremes. Just go back to where we were on March 23rd, down 34%. Things look really, really, really scary. And think about how you felt then. Now think about how you might feel today. The market's up 30% and things look better. Those are equally extremes. I think the market, where we are, is somewhere in between those right now. I think we deserve to be somewhere in between those. Here's what I will say. I like to try to tell people that what really drives the oceans are not the waves, but we spend all the time in the waves. We frolic in the waves, we surf the waves, we play in the waves. They come and they crash all over us, and sometimes they're fun and sometimes they're scary, but the waves are always there. What drives the oceans are the currents. And we got to focus on what the currents are, and that's what the market's focusing on now, and that's the long term. Let me just show you 2 last slides and we'll open up for questions. This is a really busy slide, so let me build it really quickly. These are annual returns. The blue lines are annual returns for the stock market. Anything going up means it was a year that was positive. Anything going down means it was a year that was negative. The very first thing you should know is stocks don't go down very often. They do from time to time and sometimes quite a bit. But the reality is stocks go up more often. I don't know if it's going to go up or down this year. I don't know about next year. I don't know. I just know what going back to 1980 looks like. And the last 40 years, well, it's mostly up. The second thing is notice the dots that are all below. That was the lowest level of the year. What's interesting is lots and lots of times, in fact, in every single year, the market has pulled back quite a bit. In fact, the average year has been down 14%, even though it closes the year positive. The reality is this is normal. This is what happens. And I don't want to say having a pandemic is normal. It's not. That happens every 50 years, as I showed you before. But the reality is the most dangerous thing in investing is to say that this time is different. What causes it's different? What we call it is different. But the reality is, by and large, looking forward, the perseverance, things aren't that different. The reality is, I continue to believe that the long-term holding of stocks is positive. And then maybe the last thing, just to visualize this again, these are bracketed by annual returns, and it just goes and shows you the brackets. You can see the green where the far right, all the years that were north of 25%, and in the greens, all the years that were positive. They're not always like that. You can see many years that are in the yellows there, but just note the really, really tough years. You know, the down 15 to 25 or the down more than 25. Right now, we would be in that not the far red camp, because we're only down about 17% year to date, a little less than that, almost 12% year to date. We'd be in that camp, in the pink camp, almost towards the yellow. Now, I don't know where it will end up. I don't know that. I'm just trying to showcase to you, it doesn't happen very often that you're in the bright red. This is just what comes with the opportunity to get the far right. That's why having a balanced portfolio, staying patient, having an investment plan, and making sure that you have a really great advisor, like you all do, is so vitally important. So with that, Peter, maybe we think about taking some questions and just think about anything that I might have missed, and maybe we can take a few questions. What do you think?
Yeah, that's great, Burt, and thank you so much for your commentary. It always, at least for me, gives me optimism in a difficult time, and I think you've done that for our listeners here today. So I really appreciate it. I know they do as well. We do have a few questions, and for those of you who do have some questions, there's a Q&A button at the bottom of your screen. That's the best way to ask a question. Send that to us. We'll get that, and then Burt will be able to answer. And the first question I see here is from Julie. She says, do you have specific ideas of how elder, 70-plus folks, should respond to this recession? And then she has an additional comment. She says, especially for those of us who don't necessarily have long-term.
Well, I will tell you this, 70 is young, and hopefully you've got decades and decades left to enjoy this beautiful rock that's running around a crazy fireball in the middle of the solar system. But here's what I would say. I think patience is important, and making sure that you're, deviating from whatever your plan was in the middle of a crisis is really the hardest and it almost always is the wrong move. I'm not saying it's not, you need to talk, but changing your course when you're in the middle of, a crisis that's almost never works very well. The reality is having an investment plan, whatever that plan is, staying with that through, because remember what a plan does. A plan is not just something that gets you through the good times. The purpose of a plan is to get you through the bad times so that you actually get to the end goal and destination that you have. And so what I would do is I would exert great patience here. Again, I think there's volatility. You know your situation better than anyone. I'd make sure you get with your advisor, get with Peter, and talk that out. But my guess is you have a really great plan. I'd stay with that plan, and just stay patient, because I believe that on the other end of this, markets will recover. They've already recovered a lot. I think we'll continue to see that recovery, especially as our economy begins to recover throughout the summer. As that begins to happen, you will see this market potentially begin to recover. And I do think we'll probably see lower levels than we do today. But I will also say I believe we'll see higher levels than we are today. I think we'll end the year at higher levels than we are today. And I think 2021 could end up being the beginning of the next expansion. And remember last expansion, it lasted 10 years, right? And being able to get in at the beginning of that expansion would be quite important.
Great. Thank you. Thank you, Burt. Next question. What will happen to the job market for 2020 college grads?
Oh, my goodness. Now, I'll tell you this. We were just talking about this before. I have 4 daughters. I tell people I have 8 kids because I'm convinced that girls count twice. And for those of you with daughters, you know that. So I like to tell people I have 8 daughters, but I actually have 4. I have twins, and my twins are graduating college this year. So they are 2020 college graduates. So I know this one firsthand. Listen, this is a tough job market. When I came out of college only 7 years ago, I'm just kidding. I came out of college a lot more than that. I'm 51, good golly. But when I came out of college, some 30 some odd years ago, it was in the middle of the 1990-91 recession. And I will tell you, it was difficult. And I think that's going to be really hard for the 2020 college grads. Here's what I will say, though. I will say that, remember when I told you that 33 million people have filed for unemployment? But my guess is tomorrow, you won't see 33 million people in the job loss in the payroll numbers coming up on Friday. Now, intuitively, that is weird, right? If 35 million people lost their job, then you should see that in the payroll numbers. But we have what is called the participation rate. And the reality is there are a bunch of people that have said, you know what, it's now time for me to retire. Or, you know what, it's now time for me to think about doing something different. Or, you know what, I'm just going to take some time off and go back to school. That happens during recessions. And I will tell you, I think that you're going to see, for a lot of the baby boomers, people like me that have been working for 30, 35, 40 years, that are now beginning to realize, wait a minute, I'm too old for this. And on the other end of this, just might actually give way to some of the younger folks to come in. I might have not have to go through this. I might have said I got another 20 years to go, but now that I think about it, I don't know if I do, to be honest. This last year's taken a lot out of me. The last 2 months has taken a lot out of me. And so I think you'll probably see that. That said, I think it's going to be really hard for college grads. And I think you're going to see that come through. What I'm really concerned about is debt. Remember, this is the most indebted college generation that we have ever seen because of all the student loans. That is something I'm nervous about for them. I think many of them are going to move back in with mom or dad, and I think that's going to end up, causing some stress. I will tell you, as my kids begin to think about moving back in with me, I'm going to treasure that, getting the band back together, because I know that's not going to last for long. So I don't know if I have a great answer for that. I will say it's going to be challenging.
All right. Well, thank you, Burt. And, thinking about debt, that's a big question that comes up for our clients. Our debt now is in excess of $23 trillion. If we take the 30,000 per trillion, you got to take 30,000 times 22, which I didn't even do the math, but it's a crazy number to think about how much debt this country has. What do we think about that, either short term or long term?
Yeah, so there are 3 types of debt, right? And you're talking about our fiscal debt, the debt that we have as a nation. We have corporate debt, meaning the debt that our companies have, and then we have personal debt. So that's debt for all of us. I promise I'm going to get to your question, Peter. So personal debt has almost never been this low before. Coming out of the Great Recession, we learned a lot of lessons about overstepping and getting too far ahead. I will tell you, a lot of people thought, if I'd had 5 or 6 houses, things would be great. And that looked really great until 2008 and 9. And then that sort of didn't work out so well. And so the reality is the savings rate has been moving higher. In fact, the savings rate going into the Great Recession was about 1 or 2%. It was 9% going into this recession. Right now in the month of March, it was at 13%. So you're seeing people save more and spend less. And so from a consumer's perspective, we have less debt than we've ever had. Now, granted, 33 million people lost their jobs. They're probably going to be putting some debt on. And for a lot of people that might have less hours, they might be putting some debt on. But we actually have less consumer debt than ever before. Corporations have less debt than they have ever before. Shows how good our economy was. Our nation has more debt than it's ever had. And that certainly is problematic. And make no doubt about it, it will do 2 things. Number one is it will keep us from growing fast enough. Remember at the beginning when I showed you that this was the very longest expansion of all time, and yet the shortest economic growth? Why? One of the reasons why it was the shortest economic growth is because we are carrying around an anchor that is our nation's debt. And the longer that we have that anchor, the more constrained our economic growth will be. And so the reality is it will slow us down as a nation. That is true. And so that is problematic. Don't get me wrong. Here would be what I would say, though. At the end of the day, that's one thing. So this extra debt's going to keep us going backwards. And then the second thing that I would say is, a lot of folks are thinking about whether President Trump wins a second term or whether or not Joe Biden takes the office. Either one, it's going to be very hard to have very big social platforms and changes given a massive debt that we have right now. You want to do tax cuts that maybe Republicans might want to do, or your big social programs that maybe Democrats want to do. I'm not so sure we can afford either one of those, to be honest. And so the reality is this is going to end up being a really, really, really big burden for whoever the president is over the next 4 years and so forth. That said, here is my view when I talk to Washington about how to think about this. I think if we try to pay back our debt right now, that would send us into a depression. I think what we have to think about is growing our economy to a point where $22 trillion of debt looks really small. When our economy is $20 trillion and our debt is $20 trillion, man, that feels like a lot of debt. But if we can grow our economy to $100 trillion, $22 trillion doesn't sound so bad. So I'd like to see us stabilize our debt, focus on growing our economy, which then makes our debt to get smaller and smaller and smaller and smaller and smaller. The hard part is when you pull an anchor with debt, it's just hard to grow.
Great, thank you. Does that mean, is there an opportunity to refinance some of our country's debt at this time since rates are so low?
Absolutely. And I think you've seen the Fed already begin to do that. The Fed did that through the Great Recession. Remember those zero rates for a long time. The Fed will continue to offer long bonds. I mean, we'll refinance for 20, 30 years out at, 2%, 3%, very, very low rates. and allowed to do that. So that's a saving grace because the interest on our debt is really going to be what is that hindrance going forward and the drag on a dollar.
Is it also fair to say that that inflation might help us in a situation like this?
Absolutely, and I think that's really important. You know, I think you got two types of inflation. You know, one type of inflation is exactly what you're talking about. The reality is when we devalue the dollar to some degree by issuing more and more and more and more dollars, it is inflationary. And so therefore that we're creating this sort of inflation, and that's what this debt carries on, and that will help us, right? At the end of the day, that actually will help us. Remember, inflation is sort of the smoke of economic fire. And so that will certainly help a bit. So we'll see where that goes. I think the one thing we got to be careful about is too much consumer inflation. And we call this demand or supply side inflation. So think of that as there's just not enough hamburgers out there. And so therefore it's going to get expensive. And so that's one of the things that I think we got to be careful about for consumers, is you're going to have two pieces. When you flood this economy with more dollars, which is what the Fed has done, the Fed has put $7 trillion into this economy, a third into this economy. Much of that will begin to be spent. Because there's more dollars here, the dollar's worth a little bit less because there's more of them. And so because of that, we got to just bid up things. Things get more expensive. That's inflation. Then we also have supply challenges. Whether we can't get stuff that, from overseas, or, our trade war with China, or just the fact that it's really hard right now because, processing plants for meat are shut down. All those things, those two whammies are likely going to cause inflation to go higher, which is something to be careful about. That said, it's nothing to be super worried about, because remember, the two biggest things that contribute and benefit from inflation: your paycheck, that's number one, and number two is your house values. Those two things also benefit from inflation. Third would be the stock market. So those are all pretty good.
Very good, thank you. We have a question from Dave. Could you comment on the oil and gas situation and what that may do for the market?
Yeah. Well, so there's a long one on this one. Many of you saw that oil was negative for a period of time. And one of the ways I try to describe that is the vehicle that oil trades is futures contracts, and it's a piece of paper. And that's how, people trade oil. They try to think it's going up or going down and so forth and so on. But one day a month, what happens is those futures contracts turn into barrels of oil. So if I had a futures contract, that on that day, I've got to turn it in, and they're going to give me 1,000 barrels of oil. That is the minimum that you can take. Now, what happened was, well, usually what happens is all the refineries take that extra barrels of oil and they turn it into gas and we use it. Problem is our refineries are full because we're not driving. So there's no place to go. So you actually had to pay someone to take oil off your hands, or else you'd have to go and get it. How would you have to go get it? Peter, you and I would have to go and rent 5 tanker trucks and drive to Cushing, Oklahoma, because that's where the oil is. And we'd have to get the oil in those 5 trucks, drive them back to the house, park them in the driveway, and wait for oil to stabilize. Here's the biggest deal on oil. Why is oil at these levels? It is because OPEC and Russia are putting it to the United States. And why is that? Here in the United States, we are, but a lot of people don't realize this, but the United States is the largest producer of oil in the world. We produce more oil than anyone else in the world. We are energy independent. In fact, we export a large amount of oil outside of the world. Here is the rub, though. It costs us about $40 a barrel to get it out of the ground. It's expensive for us to get it out of the ground. We have to do fracking and shale and all that kind of stuff. While if you're in Saudi Arabia, it just flows out like rivers, right? It costs them $6 to get it out of the ground. It costs us $40 to get it out of the ground. Russia and OPEC are sick and tired of the United States taking market share from them. So they have flooded the market with cheap oil on purpose to actually hurt U.S. energy independence and companies. And it's going to work. We're going to see a large number of U.S. energy companies go under. That will hurt our energy independence. This will be difficult. So one of the things I think that you've seen, and I think you'll see more of, my guess is you'll see Washington begin to think about helping to backstop some of the U.S. energy companies, given that. Now, whatever your political views are, your environmental views are on that, I'm just talking economically now, not socially, not environmentally, I'm just talking economically. And that is what's happening. So Russia is doing that. Now, we'll see how that plays out and in the overall grand scheme of things. Oil has actually been a real concerning bit. Because remember, energy companies are about 2% of our GDP. It's about 2.5% of all the employees. But remember, when you go all the way through that, it's a multiplier. It impacts about 6 or 7% of our economy. And so that is a big impact. And that's why the price of oil is concerning.
Very good. Thank you. Another question that I've been getting a lot lately is around the subsequent contagion, that once we open up this economy, that maybe the peak deaths increase substantially, and what that might mean and how we would deal with that.
Yeah, so I'm just going to declare this right now. I'm no doctor, and so I know nothing about second and third waves. Although I've read more than I would care to admit. I think there is a very good chance we do get a second wave, and most of the work says that will probably come by in the fall. The question is, are we going to be prepared for what that looks like and be ready for that? We won't have a vaccine by that. That is assured. That will take us a while, and I think best case will be late 2021 is what I'm hearing from a lot of the work that the research that we're looking at. So it's going to take a while. We're likely at least a year, maybe longer from a vaccine, and it's not sure that they'll even be able to find one, to be perfectly honest. And so I think you will see a second wave. The question is, are we more prepared for that? It looks as if 15 to 20% of the U.S. population probably has antibodies. At least that's some of the work that's been done in New York and California. We'll see what that looks like. That's a long way away from herd immunity, which is closer to 70%. And so that could end up being a relatively big deal. Remember, the Spanish flu, if we want to go back and look at history, the second wave was far more disastrous than the first wave. I think we can look back at history and know that. And so I think that we can use that. And if we don't go back and look at history and modify how we're thinking about things, I'm not saying stay shut down. I'm saying be careful. If we don't do that, then, shame on us. Will that have an impact? Maybe. If you're talking about from an economy perspective, sure. I remember what I said. Consumers have to be confident enough to spend. Businesses have to be confident enough to hire. If they think a second wave is coming, they're not going to be confident enough to hire. Make no doubt about that. And so the reality is, will contribute to this confidence recession that we're in, Peter. So I don't know the true answer to that, my friend, but I will say that it will have an impact. The market knows it. The market's pricing in a likelihood that we'll have a second one. And so remember, anything that you see and read and all that stuff, we are the market. Who is the market? It's us. Everyone on this call and every American and everybody that owns a mutual fund, we're the market. So if you know it and I know it and we all know it, the market knows it. So it's priced into what it is today. The question is it worse or better than what is priced in expectations of today? And I think they're pricing in. I think the market is expecting a second wave, but the second wave to be half as bad as the first wave. If it's worse than that, I think this market will sell off. If it's better than that, I think this market hits all-time highs. I think the likelihood is that, if we're smart about this, the second wave will be there, but it'll be half as bad as this one. And if that's the case, I think the market holds in.
Very good. Thank you. So we do have a minute or so for another question or two. And while I wrap up, if you have a question, just remember to click on the Q&A button. Burt, thank you so much. It's always a pleasure to have you. It's really an honor for you to be able to speak to our group of clients. And anytime you've spoken to us, you've enlightened us. You've given us some confidence that we might not have otherwise had. So very much appreciate that. And we hope to see you again in future webinars. We'll ask you back when the recovery's fully underway and the markets have reached new highs. We'll ask you, why did that happen? So thank you, Burt. I want to let everybody know that these webinars are going to be going on once a week in general. We've got mental health during COVID-19 next Tuesday, May 12th with Michelle Kay. We have Steve Bellotti, an Australian investor. He's going to be speaking to us on Tuesday, May 19th at 3 p.m. And then Greg Moss, former news anchor with Channel 9, will be speaking about innovation. He's now the innovation coordinator for the city of Westminster. He'll be speaking about innovation. The title is A Mindset and a Must on June 2nd, 2020, 2 p.m. We also have The plight of the homeless is going to be coming up. We don't have a date for that. And then the chief medical officer for a company called Mesoblast, which is creating doing stem cell research to attack ARDS, which is the acute respiratory distress syndrome, which is what many people are dying from with COVID. And that looks very promising. So I think you'll enjoy hearing his commentary as well. Burt, it looks like we don't have any further questions. You've answered everybody's questions. Everybody's completely clear of what's going to happen next. Thank you so much. Look forward to seeing you again. And I do look forward to that hug as well.
Miss you, my friend. Everyone stay very safe and stay healthy.
You too, buddy. Thank you. Bye-bye.